Yeah, what's up, everybody? Good morning. A little bit of a late start here, so gonna jump into this really quick. Let me turn the music down a little bit. All right. All right, opening inside DD bands across the board. VIX and Nikkei market looking stable. Got a nice, good trading day today. So let's see if we get something clean. Pull up the news and data. Fed speakers about it. Nothing crazy. Nothing going out today. Gonna be a light day. Expiration Friday. Let's see what we do get at the open. All right. I know, late start. Smash the like button, friends. Let's get ready to go. All right. QBX mic coming in. Mean reversion. Oh, very long up today. Q's yet. All right, nice clean opening setup. Let's see what's okay. Things still waiting for things to come in. Good morning, everybody. Let's check a couple tickers. Happy Friday. What's going on here? We had a new release this morning. The watch list changes. I guess wait for the data to come through and calculate. Let's see how this is a little bit different. That's kind of cool. It's the plus too. Oh yeah, remove that. That's kind of cool. So we've made a little modification in the watch list. As a matter of fact, Derek, absolutely. That's all I do is trade futures. Most all of our tools are futures, actually. The majority of, or sorry, futures has more tools than anything else, and that's all I trade. I designed this to trade futures originally. Now it works for everything. I'll have to show you how it works. Give me a second, let the market kick open. Now I'm just kind of, we had a new release right now, and I think waiting for my data to come through. Let me show how this works. All right, let's see if I can do like F. This is an invalid input. Testing these new things. Oops. Okay. Looks like they still have that check and balance there. Okay. Okay. Good deal. Nothing is populating? Okay, it's at you guys as well. Taking a look at it. Good morning, good morning. Yeah, it should be a new contract. We have a rollover today. Looks like we are. Let's run the Z contract. Actually, I'll run it tomorrow. Let's just keep it on you because I'm still. You know, okay. Not really sure what's going on with a little miniature data outage today, so sorry about that. We're going to look at this and see what we can do to pull this data through. So hang tight, and if you have any, whoever had questions about, let's see who's asking. Derek, new looking to buy, not sure Evergrass, but yeah, dude, don't even worry. Like, I'll give you a little tutorial about it. Right now, our data feeds have we had a new release this morning, and it looks like something froze up on that. So we have a brand new. We've just kind of re-upped the face on the platform, give this whole brand new awesome layout, look, everything, and so we're making like little changes here and there to kind of optimize the final parts of it. So it's looking pretty clean, but looks like we have our liquidity map. So what normally happens, and I'll walk you guys through this, is that liquidity maps are going to be a series of codes that are going to correspond to certain setups that I can look for inside of these ranges. So it's essentially we look at options data. And so, for instance, if you trade S&P futures, you can use a liquidity map on SPY, like right here. It looks like let's get an example. Let me refresh. So what it does is it shows you where, based on options, certain hedging type pressures will be, where you have forced hand buying and selling based on where the options landscape is. So, for example, futures will pivot when the SPY pivots, and they're going to pivot at the same place. And so we use in equities world, this is one of the tools we have to kind of map out trade plans. So an example, if we had this one, I would look to long off of blue or short of blue breaks. And so I use liquidity map as a guide to kind of give me an understanding of what's actually going on under the hood, minus the randomness of what humans are doing. This is all the algorithmic side of the market, the automated trading that takes place to balance the risk and options. So it's a neat little trick that we invented. It's really, really, really accurate. Now, like if I know that an example is the letter codes come out like this. So right now we're still waiting for the data. Usually it comes in about 30 seconds. And so today we had some kind of detachment. So it should pop up whenever he's finished checking it. But anyways, if I were to went along here and it starts breaking and go below, I just know to get out of the way because there's no pressure there to keep it going. So it's kind of how our bread and butter here works. Let's see. Did SPY open flat today? Let's go ahead and do this. So it looks like we have liquidity maps coming through for major tech. So it looks like QQQ, SPY, UVXY, this should be down. All right, cool. Looks like IWM just came up. Here's an example for IWM. So we'll look at the Russell today, and yeah, for whatever reason, SPY and Qs didn't come up, but everything else did come. All right, a little late on the data here. So let's take a look at the market resilience being negative, right? And we are trading up on the top side of the redistribution zone. So that's not necessarily the best sign of the world. Does everybody see that right here? And let me, wait a minute. Let me add, wait, my resilience is also frozen. Okay, hold on. Let me refresh the whole platform. Hold on, guys. Sorry about these little bit here and there. Growing pains. Okay, let's try that. Actually, let me close everything down and reopen it. 1 second. Sorry about this, folks. So, we're getting things back on now. All right. So resilience actually was positive. Okay. Okay, S&P resilience is actually greater than 0, so that's good for the setup. Resilience shows, and if you look at our cheat sheets, and I'll walk you through how this works. Cheat sheets are something that we give you to help you quickly understand what the different signals are on here. Redistribution zone is a mechanic of the open and close in futures and in index ETF or anything. Resilience is an indicator, and here at the bottom, this white line is greater than 0. So when it's greater than 0 and you're outside the box is support to trade a little bit higher. So today the market's going to be a gap and go supporting right here and likely hold as long as resilience is greater than 0. That's number one, which is looking good. Apple and some other big stocks starting to move. And upper target, of course, today, 44.88 on this DD band. Does the DOM freeze in live trading? It shouldn't. I haven't experienced it freezing. Not the DOM. Yeah, res is positive. Yeah, for some reason, now we're getting, things are kicking off pretty good. Okay, so another thing is liquidity map. So demonstrate with Apple. Apple right now, BL talks about here. The open price, if the open is support, you can trade up to next resistance. And here's the open support, trading up to next resistance. It is a supported trade from the opening price at the start of the day. Anything below the open, I look to long on hedge pressure right there. So when you put them all together, you can see how there's a general pressure where I look for markets to ebb and flow based on the delta hedging of the underlying option, the options of the underlying. So when you're trading futures, an example is you would do the same thing with SPY for ES, or you do the same thing for USO for oil. Whatever futures you're trading, he was asking earlier, Derek, it's legit for same thing as to be have more tools. So it's the same exact thing. Futures have a few more things, like the S&P, the CD ratio tells me that the S&P majority of the stocks are in their own bull zones, and a bull zone has to do with bullish risk. So basically there's more bull risk in the money or calls in the money based on our risk algorithm and not a bear zone. So an example with Apple, like we are trading in a bull zone, which means that you just have more bulls than bears right here in the underlying. Next resistance is any resistance you find. If you go through the exit targets, great question, Jeff. Any resistance that you can find on a day trade. So what we try to do is we'll trade from one support to one resistance for a day trade. Now you determine what your resistance is. If you're a swing trader, it might be at a different spot than a day trade. On a day trade, I try to find the very first thing it can bump into. If I know the pressure is positive, I'm going to long to something. So we got to figure out what that something is, right? And in the exit target section of the Discord, if you go through our boot camp, all of you that are here to learn, if you go to the boot camp, go to show really quick. We have over here, this is all for the members here, entries, exits, etc. The exits show you ways to find resistances. So in a stock, you know, the first thing you always look for, especially if you're trading internal to a move, for example, Apple's trading up, you're gonna look for gap fills. So one of the easiest resistances to do, let's just draw some lines, horizontal line here, like so. So gap fills are always one of the easiest resistances to find. So like on a day trade, you're always looking for it to bump into its resistance that it created on the way down. So for example, you're selling, there's a sell imbalance, then you're going to use that as a return target on the way up. So here, Apple today. Does that make sense? So Apple pushing up higher, and of course the index is kind of bumping into something very similar distance relative to it. Yeah, for some reason SPY and Qs are down today, so we know why it is. We're investigating. It should be up pretty soon. I'll make an announcement. All right, let's take a look at a couple other things. All right, today in the news, there's not really anything that's pushing the market, so we don't have a lot of stuff that's gonna come out as a catalyst. There's really not a lot of anything. Some Fed speakers. It's really nothing there. Nothing. Yeah. So nothing today. It's gonna be a light day. We have Friday expiration. I think we're rolling into a new S&P contract. I think can create a little bit of turbulence. So, and all in all, it's just gonna be probably, hopefully, like a clean day. Keep an eye on these resiliences, make sure that the market is steady there. We call this golden setup. All lights are green, right? There's nothing that's really bad, nothing really crazy. I'd like to know our hedge pressures on S&P, but what we do know is we have the open price to be support. So in here, hopefully the market stabilizes and supports. Friday. Consumer credit report. Is that today? Oh, yeah. I don't know if that's going to move the market a lot, though. But yeah, that is today. Thanks for telling me. Another consumer confidence type number. All right. So
for my next trick, I will get a real offer to sell this car.
Ads pop up on the music. So today, yeah, just generally update. So those of you that had questions about what it is and what we're doing, I'll give you the general tutorial. Is our technologies are different than anything you've ever seen before. We're not using any kind of multi-time frame analysis. We're not using technical indicators. We have three major tools that we use for entries and direction. Actually, four now. A DD ratio has to do with the bullishness of the market. This number greater than half, it's just generally a bull market. It's been that way almost all year, and we've been in a bull market all year. It looks at the percent of stocks that are in bull zones, it's percent of market cap. So bull zones have more bullish pressure to the market. as people are, calls go in the money, they're more willing to long the market than short the market. Resilience is a gap fill predictor. So when this white line is above 0, it's telling us that we gapped up and it's more of a gap and go rather than a gap and fade. Like I wouldn't short this market when resilience is positive to bet that we fade and close the gap. So the gap is likely to hold, which is a good sign. And liquidity maps are a way to piece together all the hedging and information from options landscape to get information for the entire index or whatever it is you're looking at. Stocks, all of them have liquidity maps. In futures, we have pivots on these DD bands. If the market opens inside of these green bands, it's considered stable and rational, so markets are nice and clean. These bands are typically barriers. So when I trade, I look for them to be exit targets. All of our alerts are nice and clean today. Nothing really crazy. So market's looking good for some upside move. How often is risk interval calculated? Once a day. Yeah, I made an announcement. The SPY and Qs are down in VIX for a temporary out. But it should be out pretty soon. Monthly map is the fourth thing that we look at. So if I were to look at monthly map, now again, SPY is down, so it's going to show this one right here. We have the monthly map wall, so let's pull this up here. One second. Let's see monthly map. Monthly map is how we extend risk and show pivots over the course of time. So this goes all the way through till the end of the year. And you can see that we really don't have a really strong, let me make this bigger. We really don't have a strong, from where we are now, bull zone, bear zone, nothing. Actually, it's trading like in no man's land. There's literally nothing here. So normally you're going to see if your bull zones are this darker gray and bear zones are this lighter gray. And normally they're going to be a really nice clean distribution. You see how the market's just completely shattered and it's weird and all over the place? This is the emergence of a possible bear market. As we can see, look, there's all these bear zones popping up. So the way that it's framing, and this could be the high of the year, unfortunately, what was nice and strong and bullish all year long with bullish read on this. And let me show you what this looks like on the cheat sheet. This is how you interpret this. You've never seen these before. This is pretty cool. So cheat sheet is a section of the Discord that's going to have all of your graphics to help you just kind of follow the different things that we teach here. So this is the one on how to read monthly maps. And so typically when you have a nice clean map, there's going to be a nice clean distribution. You're going to see nice bull sides and bear sides split just like this. But as you see, it's just like a chaotic mess. And it did that ever since we had the Fitch downgrade. So this chaotic mess has just been present ever since then. The market shattered the bull hope at that moment in time, and it has not restabilized. Now, while we're having some waves to the upside, the market clearly does not have a clean bull path going forward. It's not bullish and it's not bearish, but the bearish side is starting to creep up closer to price. So the bear zone being flat means that nothing's changing there. The bull side disappearing means that there's not any bull support. Now there's spot bull zones in here, but it's not really that strong. So the way that this looks is that this is going to be a flat, choppy market, not bullish, not bearish for a little bit until it starts selling into bear territory, and then it becomes a little more bearish. So with this look like this, it's not really that clean. Now let's look at something that's clean, so easier to kind of see how this works. Monthly maps on the best things you've ever seen. We're coming to predicting risk in the future. Look at NVIDIA, nice and clean. NVIDIA is bullish as time goes by. This bull zone is sloping down. If you look on here, if the bull zone bottom is sloping down, bulls are longing more. That's what that means. So NVIDIA is becoming more bullish over this period of time, and that is a month of time. So NVIDIA is still bullish. If the bear zone bottom is sloping, top is sloping down, like you see here, then bears are exiting positions. So not only do you have bulls longing more, but bears exiting more at the same time. So you have short squeeze plus added longing. NVIDIA is still going to stay bullish. Bada bing, bada boom. Apple, similar boat. Apple is still bullish over the short term. You can see how that works. What time the risk interval is calculated? We calculate it 15 minutes after the futures market opens every day. So for the new night, calculate the new risk interval. When I say gap and go is open price below open, gap and go means that you either gapped up or gapped down and you didn't return to the previous day's close price. You can gap and go to the upside, you can gap and go to the downside. So if whichever direction it gaps to, it doesn't fill, it doesn't return to the previous close price. So resilience is that gap and go type indicator, predictor. Yeah, it looks like today just going to be support on open as long as res stays positive. So keep an eyeball on res, this white line right here in single web 0. Could we see stocks head closer to their MHP? So stocks and their monthly hedge pressures converge as you get closer to monthly expiration, which is next week. Let's show where that is, right? So either monthly hedge pressure moves closer to stocks or stocks move down to monthly hedge pressure. They typically interact in the last couple of days before monthly expiration. So every morning when these are calculated, it's going to move around. So as you see, Apple is, looking to expire somewhere in here maybe. As this goes up, they tend to meet and interact with each other. So it's hard to guess where it'll be in a week. Yeah, Ralph, literally resilience, dude. It's like the 3 indicators we teach you in the first couple of days of being here. Resilience is positive. It's a gap and go. Straight up. It's the easiest way to describe it. I mean, it's right on the cheat sheet. This was a simple analysis for this one, but we don't have our liquidity maps are down because we're missing some options data. We're getting that pulled through. This is the new release. Didn't take, but anytime resilience is bullish resilience, all clean signals. Open is support, elongate the open if it starts trading higher. So if it longs up, just jump in on a pullback long. That's how most people do it. Too late now, but like what I'm saying is that's what the opening thing is. Not investment advice for anybody to trade that way, but that's how I do it. As the market opens, if you gap up and then you trade up higher, this is support as long as resilience is positive. So you got to be ready the moment the market opens to follow something like that. And then we would obviously use liquidity map to have a stronger support. if we had a hedge pressure or something else, which we don't know where that is right now. But all clean signals, not irrational inside DD bands. You know, things are solid, easy today. Yeah. Okay, Alexander, glad I answered that for you. So my call today is, as long as rest stays positive, the market can still try to press higher. I mean, it's just depends. Keep an eye on it, obviously. It's not really getting a lot of bull power, and that's because, you know, those monthly maps are showing it's not strongly bullish on the longer term, even though right now you have still enough stocks in the bull zone to keep it from crashing out. So my call today is that it presses up towards this upper green band rather than selling off. I think that's probably going to be more appropriate for today's setup. Now, NQ is close enough to its band as well. So NQ's upper target today for NQ futures. So getting sorry here, right up about there, 15,400 give or take. Right, today's upper target would probably be right there. There we go. All right, so liquidity map in. Finally, here we go. Snapped right into place. All right, bull long up. So let's talk about, okay, futures. You guys ready? Let's analyze the futures. Finally, the data came in. Let's go. So we do every morning. This is the process. So you're going to have a couple things. Let's get my handy dandy drawing tool here. And everybody, if you don't mind, smash that like button on the stream. We love having you here, friends. Okay. As you see, hedge pressure being a support, pushing higher, obviously in this mean reverting middle. Anytime, actually price is in the middle. Let's actually talk about here. We open in the bear zone, it looks like. And we'll start with the resilience thing we talked about. Resilience presses to next resistance off of the open. Just that little tiny push right there. We're going to bump to the bear zone and call it. DD being bullish, let's talk about that DD bullish ratio. If you open in the bear zone, I tend to look for a bull zone tap just to connect this to this. So when SPY pushes to the bull zone, I typically call it a day. Now we know that. And I anticipate the market not to rally from here on a day trade. So I tend to just long to there and call it normally if it does break into the middle. From the middle, the tie break pushes to the bull zone when it's hovering in the middle, and hedge pressure has that natural bull float once you broke through it. So in general, this is kind of a hard one to see because it's not really easy to take the trade off of this one. I would have longed from here and held my britches and called it right there. So DD ratio being greater than 1/2, it's showing now that the bull zone support is where the new support is for the trade. So this is like trade number 2. Now this is a smaller probability trade. I don't normally take it for the breakout or the second wave. But all things are pointing up. Looking good. Let's look at Qs. QQ kind of in that same boat. It was a bull short up that broke to a bull long up. Bull long up trading next resistance, and next resistance is DD band. So Qs right here. Same thing, pushing through here. Just a little hedge push break, which is kind of neat to see. So right about that 375 level today. Yeah, so now we do have hedge pressure breaks to the upside. So that was a neat little push. And this is the way I like to say, like when markets are, at the start of the day, this is what I would have done. Now that I have all the data, I would have seen this, I would have seen this, and hedge pressure in the way I would have done nothing. I would have seen, on NASDAQ, I would have seen this and hedge pressure in the way I would have done nothing. It would have hit hedge pressure and started breaking through it and bouncing on the other side. And as it's bouncing on the other side, I would tell myself, okay, maybe there's a hedge pressure break. Remember the last 2 days I sat out, didn't do anything because I was waiting for a nice bull breakout to take a long on. And then now we have the hedge pressure break. I would say, okay, maybe I'd like to take a long, because whenever I talk about on my videos, I always look for an excuse to take a decent long on a break to the upside. So now we have that hedge pressure break. I can say, where do I think it's going to go? Well, here to the upper bull zone is a possibility. Okay, maybe I'll long from here to here. But then I go, it's probably only 50 points. So a day like today would be kind of hard to me to make an opening move, other than I would long at the open to somewhere. And again, this is only about 10 points of spread. I probably wouldn't have taken a day trade on that. NASDAQ is a little different. NASDAQ really had nothing in the way. It's bull side, broke through hedge pressure and supported. This might have aided my idea to want to long to somewhere, and I would see DD bands very close to here, and I probably would have taken it. So that's how I would have perceived it. NASDAQ would have been a great runner off of hedge pressure. S&P, I wouldn't have taken it because it would only be like 5 points, and therefore I probably wouldn't have done anything on the S&P. I would probably just see NASDAQ and said, oh yeah, let me long some NASDAQ to here if the risk and reward is there. So essentially today, I think we're limiting to the CD band tap. Typically, if you open in bear zone, you want to close in bear zone. So whatever you get up here is typically short-lived, just like I showed on this infographic, right? If you open in the bear zone, which you did, once it taps the bull zone, I usually get out of the way. I don't bet on it continuing to go. Usually it's bull trap, as you see. Now, it could support there. I don't take the secondary trade. If I were to be long, I would close there and call it. Y'all follow? Pretty neat, right? How these just kind of showcase that. These pressures are always there. We open in bear zone, it taps the bull zone and starts resisting, just like I showed. And so those of you, if it's your first time here, Is this starting to make sense to you, Derek, and other people that are just checking it out? We don't use any technical analysis or historical data or anything. We look at current pressures on the market based on the positional landscape. It's a whole new way to think about markets. And the proof is in the pudding. If I draw these little cartoons to hand out to you guys, and you see that the things I draw have that repeatableness to it, there's something that really is going on that we're exploiting. So even though it's breaking out to there, I don't take longs on bull zone breaks. I bet that, remember, when all signs are rational, despite a hedge pressure break, I tend to bet that you close in the same zone you open on in. That's what we normally say here. Is commitment traders a week-old data? Yeah, a week plus. The report comes out from the previous week's data. To an intraday trader, commitment traders should not be used for intraday pivots or trading decisions. It's week-old data. It's designed for you to see the ebb and flow of large amounts of money over time. It's to tell a story of what's happened and what's happening. It's the true story. Commitment traders is the actual reality of the market. You can be smarter than everybody in Wall Street who talks about why they think markets are moving by going to commitment traders, picking your index futures products, and then analyzing it. I heard people call this melt up, short squeeze, fake rally, and the commitment traders showing the asset managers the net long position. This is your 401k that you put money into every week. This is your IRA. These are mutual funds. These are all the long only side of the markets. These are people that just buy stock and sell it. And as you see, their net long position is becoming more and more and more net long. This is not a gimmick. This is not a stupid bear squeeze crap. This is literally asset managers bullish the stock market straight long. And so the story tells you what's really happening. So today, as I'm looking at today, I'm not looking at today's data points to pivot today's market. I'm saying today, this isn't a fake rally that's destined to crash because it's just a bull trap or some crap people are saying. It's actually as long almost as it was at the peak of the 2021 rally. So it is institutions buying the dip to hold to get in. And I tell myself that and I go, okay, that's interesting. Oh yeah, well that DD ratio is also 93% stocks in a bull zone. These are genuine bull signs in the market. So that's what commitment traders is good for, Ralph. It's like a storybook. Is this a short squeeze? Well, the blue line is your hedge funds. That's your short side of the market. And your hedge funds, while they continue to short and continue to short and continue to short through the sell-off, they are getting slightly squeezed in bumps, but they're still trying to short really hard. So it's not like you're getting the blue side trending up and squeezing like you did in COVID. See right here, post-COVID? The blue was squeezing from April until January. That fueled the last part of the rally, the short squeeze. But you're not seeing that here. You're not seeing a massive short squeeze lifting this up, which means this right here is a stronger rally than that is. Let me pick a different color. Let's pick like black, easier to see. From this moment in time, asset managers were longing until about right here. The market still rallied. Why? Well, because the shorts were continuing to squeeze, becoming less and less and less short all the way till there. And as you see, the market continued to move higher until there. And then once you had new shorts, and then once you had asset managers selling, then here everybody's shorting and selling. And since these both point down, there's your bear market, a genuine bear market, a correction. And then from this moment in time, the asset managers started longing again. This is a bull wave. And the shorts are not squeezing yet. So it's like, this is the false rally, a short squeeze. It's not really longs buying. As a matter of fact, longs were dumping their positions, only a matter of time before this comes down. This is a different setup. Longs are selling a little bit, yes. Market is floating because shorts are still covering a little bit, as they've been covering since about April. So from about here to there, the shorts are squeezing, despite any little bit of long selling. So you have selling and buying meeting each other. That tends to consolidate markets. And that's why we're not crashing. That's what the commitment traders is good for. Isn't that crazy, right? So why are we not going to crash today? All the doom and gloom bears buying short-term puts. you have, since April, the net short position has become less short. Since about here, shorts are covering. And a short squeeze characteristically on a daily chart is actually the concavity points upward. This is what a squeeze looks like on the short side. A rally tends to look like this. And you can see the inflection point where the rally turns to a squeeze. The curvature is a little bit off. Let me draw a little bit better here. You see that? It's like this is kind of slowing down. This is kind of speeding up just a little bit. Let me draw there. Let me draw from the bottom. It's easier to see. This is speeding up. So that like concavity shift takes place from the long pressure pushing the market to the short pressure squeezing pushing the market. The concavity changes. And here's your short squeeze. There's that curvature up like that. It's flat and flat and flat, and then it speeds up. How cool is that? There's a short squeeze. But the short squeeze also is accompanied by additional longing, so it's strong enough. So markets are liquid here. This is not a scenario like this. This is not going to turn into that. Not yet. We don't have evidence of that. Now, it's starting to, in the last couple of weeks, look like that. Yes. But remember, this is week-old data. We have green ticking down and blue ticking down, which is not the best sign. When they both started ticking down right here, that was the start of something bad. So it could start to grow and build that right now. But as you currently see, over the course of time, people have been trying to short this when the shorts have been squeezing. So just to give you a story of how the market's looking right now. This, to me, I perceive this as flat over the last couple of months. This is flat-ish with slightly down over the last couple of months. And as you see, that's just consolidating the market. If the green starts buying again, you know, we'll start to see that pushing higher. If the green sells while the blue shorts, then we're starting to correct. And it's week-old data, so like you have to say, it's just not really actionable today. Clearly, you know, this is from August 28th, so this is just giving me a history of kind of what's happened. But I can see the integrity of the market clear as day. Another rule of thumb is when this red line, which is the market maker's side, the dealers, anytime the dealers have a net positive position, like here, the market's never crashed one time in the 20-year history of this report. So from here to here, whereas right here, people were like, oh, market's going to crash. It's definitely going to go. Never, 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 when the dealer position is positive, the market makers, when they're holding a long position, a net sum of them, they don't let the market crash on themselves. They control the price. That's the easiest assumption you can make. They hold the inventory. Why would they crash it on themselves? So from here to here, as they maintain a net position, the market didn't collapse. It was trying to trade down, but there was still bullish pressure, and that dealer side tries to float the market higher. So from here to here and here to here, the dealers never let the market crash on themselves. This is big brain idea. And this is why you guys join Rocket Scooter, especially in the extended trial. We even let you have access to these videos. You're going to learn the real ways to see the market without your little rinky-dink squiggly lines in your charts that have been killing your portfolio ever since then. Anytime the dealers have been positive on the S&P futures, the market doesn't crash until they're negative. Now, this is before the big market crash in 2008, but the time that they were positive, you can see that the market still was floating, and then one safety net is gone when they're negative. So even here, before the biggest crash we've seen in our lifetime, it didn't crash until the dealers got out of the way. Same thing here. Market was trying to sell off. Dealers are positive. It floated the market. Market tried to sell off. Dealers are positive. Floated the market. See that? COVID happened. Markets rallied back here, consolidated. What happened? Dealers are positive. Floated the market. You're starting to see a trend here. Big correction last couple of years. Dealers are positive. Most of it floated the market. Isn't that crazy to see? We sell our crap to the banks. Who's in this red category? These are investment banks. All your large market makers, liquidity providers, investment banks are all inside of here. So when the banks hold the inventory, when they're long the market, it doesn't crash. How beautiful is that? And that's something you could take to the bank, no pun intended, or maybe pun intended, I don't know. Did y'all learn something today? A government shutdown, like of the government itself, or a government shutdown of businesses like in COVID. Like the government shutting down, meaning they like all the politicians and teachers and stuff go home? Or federal government, state government? Can you maybe expand on that? So we teach you how to really see markets here, and that's a whole different setup. Right now, the market is still trying to be bullish, but it's having a hard time doing that. This is what the answer I'm going with. What kind of market are we in right now? It's a market that's still trying to be bullish, but having a hard time doing it because you have some conflicting opinions. You have a little bit of short pressure squeezing, keeping the market floating, and you have longs selling just a little bit, but still hanging on. You have stocks stuck in bull territory, which means over time, they're just getting that additional long pressure from being in bull territory. You have the indices above their monthly hedge pressures, which is also showing positive gamma for the month, which means over the course of monthly periods of time, it's just the market's still floating higher despite any selling off. So you have a bull market that's trying to stay bullish and not trying to crash yet. Commander Trader supports that. All of our tools support that. But it's not an easy bull market because we're not getting those nice, clean days, but volatility is collapsing, which is another reason to believe still in this bull market. You don't have volatility collapsing in a bear market. Rule number 2 is either everybody in the world is completely stupid and doesn't see anything bad happening, is too blinded by hype for this tech rally. The thing is, the tech rally is not a tech bubble, and I think people are confusing the two. We've had an extremely strong tech rally, and people are like, well, we're trading so many times over earnings, this AI thing's going to bust. But bubbles need to inflate, and then inflate further, and then overinflate, and then super overinflate, and then they pop. You don't just re-rally to highs and call it a bubble. That's, to me, newbie analysis. So a lot of people are like, we're in a tech bubble. I think we could be in a tech bubble in a couple of years, but I think it's like a balloon that you barely just put a little air into it, and it hasn't even started inflating yet. It's just starting to. So I don't think we have anything that can pop and crash the market just yet. There's a lot of bad news swirling. We have quantitative tightening. That lack of liquidity is keeping the market from being as strong as it could be. But with the Fed tapering rates, we're tapering rate hikes and other things, and good economic data coming through. GDP is good. Unemployment data is looking good. I mean, you have all this good data coming out that shows small growth in the economy. Everybody's been calling that soft landing. Is that enough to keep the market from crashing? And I think so. I think Wall Street's been betting on that soft landing for a while. And even a year ago, if you guys listen to all my rants, I provided a lot of really strong cases, and I even tweeted about it, that the market, as the market was selling off, people thought this was the doom and gloom of this is the next 2008. And it was very easy to see this coming. Quantitative tightening, we haven't seen that in our lifetime, my lifetime as a trader. Rate hikes, everyone knows to bet against that. But despite that, economic data was starting to improve. We started to see inflation come down, and all these other things just slowly start to get better. And I think Wall Street back in middle of last year started betting on economic recovery, not just betting on a hypey bull rally on tech. This is a bet on stronger economic data, and we've seen that. We've seen all the data come through stronger. Look at this. Even the PMI is starting to stabilize and not collapse on itself. Let's super cry. We have a couple of things we're looking at. Unemployment data is looking better. Jobless claims looking better. Non-farms somewhat looking better. Productivity is down just a little bit. But still, it's still good. Quarter-over-quarter growth is still positive, which is great. You're getting productivity going up. Your efficiency, your labor is better, and all wages are coming down. These are all great signs to curb inflation on its own, which means the Fed's going to have a lighter hand on the market, despite QT. And QT is the reason why we're not S&P 5,000 right now. We could be. Without that liquidity, we're not getting those just soaring green rallies. But with the economic data improving, we should be soaring, but we're not, and that's because of quantitative tightening. And slightly higher interest rates is slowing down growth because people aren't easily able to get credit these days and things like that is slowing down growth. And that's kind of why we're not rallying really fast. It's still that kind of soft landing. The market's going to just fight its way higher probably for a year or two till everything really stabilizes. But overall, I'm not in the boat that thinks the next crash is immediate to happen, because markets don't crash with good economic data. They just don't, until people start filing bankruptcy and companies are trading at all-time highs or close to all-time highs right now. And we're going on hiring sprees. These are great signs of an improving economy that shows no signs of deterioration around. These are continuing jobless claims have been in decline since May of this year, which means unemployed people in the COVID nonsense, right? They got unemployed, came back to work, got a huge salary, got laid off, got another job, got laid off. All that noise is done. Now the market's stabilizing. Now companies are rallying, and now people are getting their jobs back, as you see month after month after month. Almost for 6 months, companies have been hiring sprees. Jolts have been in decline, continued jobless claims in decline, means a hiring spree. So companies don't go on hiring sprees unless they're anticipating meeting those people and affording those people and then being efficient enough for the money to invest to spend on them. That's a great sign. And you have a lot of really good signs. The market's just slightly, the economy's improving. And obviously Wall Street always bets on something before it happens, right? And so back then, your smartest quants in the world were saying, yeah, the actually economic data is probably going to start improving under these conditions. And they started longing the market back here, and look at that. They were right. And the market just fought its way higher on that improving economic condition. So things are actually rallying genuinely, and people are genuinely longing the market, betting on that soft landing, maintaining the course. Now, again, it's not a immediate like V-shaped rally like this, but asset managers that got in here are probably going to be happy over the next 2 or 3 years, as the market's probably going to do that. Maybe not be so drastic, but it's definitely, as long as data is improving and as long as nothing wonky happens and inflation comes down and Fed stops raising rates, market's going nowhere but up. This is the start of a rally. Now, it might be shitty for another year. We're going up. You hear my cat meowing over here? The federal government can't agree on a funding bill for the following. Just curious, since that's likely in the horizon. Oh, in my experience, those haven't really created mass turbulence in the market, like changing sentiment or reversing markets. I'm always worried about like short term. You know, anytime something happens, clearly if it's on the horizon, it's not gonna, you know, people are gonna be betting on it now if it was really happening, or sorry, if it's really gonna have an effect. So like, you know, something that everyone knows is happening, they're already making bets on it if it's important to them. So things that you know that are coming, that are possible, it probably could have had its effect already last couple of weeks, you know, or last couple of days. But as far as like something happening and that causing mass panic in the stock market, I don't think so. I think the motives of Wall Street are slightly different right now. The motive on Wall Street is nobody wants to miss out on a tech bubble that just started inflating. So even if we have another bearish 6 months or a year, there are people that just can't wait to get in on a dip. It's not hard to see that. Volatility doesn't just outright decline if people are fearful of something happening in the market. Does that make sense, Kevin? That's how I see it. VIX is your telltale sign of people's anticipation of illiquidity or volatility. And you just don't see VIX plunge with the perception of severe market safety if there was immediate doom on the horizon. You see VIX would start to build some of that in. And maybe that was what this last week was. And then the bulls got their dip. So let's talk about VIX forward curve really quick. Let's talk about VIX in the future. Let's see what people think about October and other months. VIX right now is trading at 1475 for the current month contract, right? This is the September contract. Here's what October looks like, right? 16. Sorry. Wait, we're in September, October. December is 17. So we're still in contango for the next couple of months, but still under 20. Being in contango and under 20 is signs of a bull market. That's futures trader 101. Bull markets tend to have VIX and contango, which you see the bull market that we've had has had VIX and contango, and maintaining a value under 20. So basically, you know, you provide that rollover volatility. Obviously, people are pricing in anticipating future volatility. But, you know, 16, 17, we're rolling into the new contract slightly higher than this last contract. So the volatility is actually going to be less on rollover. Now, again, we got a couple weeks for that to actually, or a week for that to actually manifest. But this is characteristic of a bull market. I mean, very strong. So I don't see people building up a lot of fear into that. Like if you're going to see anticipating fear like we had back in these days, you'll see a whole different side of that. VIX would be elevated. Contango above 20. Yeah, that's typically, if you're above 20, you're likely to have a lot worse time, a lot more fear. So I tend to see it like this. If people were really building into something, you'd see that tumultuousness here. But like even with the last couple months of selling, the market is still not showing volatility. I don't know if what they're trying to do is squeeze every bear out before they let the market fall, which I'm betting on. Like right now, all these bears are just waiting for the market to fall. Right, all these bears been shorting since the bottom. Still short, still short, still short, waiting for it to fall. Looks like the master manipulative force of the market is just trying to keep this from falling, to burn out that premium. I don't know. Or there's just a strong enough bull force that it's keeping the market going. But I tend to look at DD as the master, my master guide. This does not lie. And over time, while the monthly map has been shattered for this month, as we roll into future months, we might see changes that might restructure to a bull side. But you see this DD ratio being 93% and hasn't wavered. Even in the last couple months of selling, it's still strong, which is interesting to see. There's enough stocks still in their bull zones keeping this market floating. And we looked at a bunch of them today, like NVIDIA, looking great. All the tech stocks, they're looking stellar good. Apple still, look, all the tech stocks still bull long up and pushing. There are people that just can't wait to get into these things. Y'all see that? Oh, the risk interval on the VIX is incorrect. I need to correct that. Somebody pointed that out and I forgot to do that. I need to go fix that. Thanks for letting me know. I will go fix that today. But it just to me overall, you can easily see that nobody is afraid of this market, and VIX being that telltale sign. They're trying to be, but as you see, there's just enough liquidity here, and it's hard to pinpoint what's causing that. Monthly maps usually can reveal that. But we have this kind of no man's land after today. It was not bullish, not bearish. We don't have anything here. So this is really hard to nail down what's going on the longer term. So it just shows that the market is likely to consolidate. It's not volatile enough to crash. There's enough shorts covering to ward off any long selling. There's volatility is in decline as people are not betting on a strong, anti-bullish fall. TD ratio is still positive. It's a bunch of good signs. Slightly improving economy. My call is that we're more likely to consolidate at these highs rather than sell from these highs for the next month or two. And when the monthly map looks like that, it's like a mean reversion. That's typically what we consider it as. Just a giant, not bullish, not bearish. There's no bear zone or bull zone where this line is as time goes by. It's trading like a no man's land. All right, so keep your eye out for this upper 15,400 level in NASDAQ, kind of upper target. Enjoy it. All right, everybody, head over to click that link below if you want to check out the extended trial. You can play with the platform yourself. Start coming to our boot camp. If you're in the trial, you can go to all 3 months of our boot camp, which is great. You can learn everything we teach here and utilize these tools as part of your trading diet. We're glad to have y'all. I'm going to call it. It's normally what we do is kind of stream for an hour, and we come back and hop on Zoom for all of our Pro Plus members. So if you actually join the program, you come to my Zoom call later. You're in the Pro Plus group, and we'll continue to analyze the market and talk about and train different techniques. Appreciate you coming here today and supporting the platform, supporting our growth and drive. We love you to death. Y'all are amazing. We're doing this special deal still, $35 a month to check out the entire platform with all your data feeds, which is amazing. It's normally $200 a month, so you can do that for 3 whole months at $35. You can learn how to trade and maybe stick around, maybe go on your merry way. Either case, you probably spend $35 a month on junk. Yeah, junk food. You got a whole month of training, and we're growing super fast, and people love that little deal. So come check it out and learn from us. Play the platform. We'd love to have you. We'll see y'all later. The link is below the extended trial. There's also if you go in the description, there's also a link to the Discord. You can go there, and somebody will be with you and kind of give you a tour as soon as you join. See y'all later.